we have the largest bubble in the world, which we have right now, larger than 1929, it's larger than 2000, it's double the size of 2007.
The end result is ultimately all roads lead to inflation and currency debasement because it's inflate or die.
I say going into mid of 26, you're going to see a massive Dixie rally and it's going to crush precious metals. Bitcoin is going to be completely annihilated, and then you're going to see the dollar actually, one last time up to the new highs.
I have to challenge you there. First of all, that means somebody has to buy more of it. Somebody has to decide debt instruments are worth way more than they're currently priced at, and has to buy an obscene amount. For every small percentage, they have to actually aggressively buy a market where you have China seeking to exit, you have every BRICS nation seeking to exit.
Gold is the new strategic reserve asset. It's a better store of value than paper money.
But that's not what you can do in a deflationary bust, because that is when the dollar is everything, because you need to pay your debt. So if I get it right,
when you say the dollar is everything, you're saying the debt instrument is everything too. You've got to talk about both. Who's buying the debt? You're going to get caught out trying to buy on a 40% dip that never comes. All sorts of things can occur. Debt-based crash is a fiat-based crash. It's really that simple. The anti-fiat trade is gold. You buy gold, you are actually anti all fiats, and particularly the hegemon fiat. That's the dollar.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexei Joranov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. And we are back, this time not in South Africa, overviewing the deep and beautiful landscape of Cape Town, but in the digital realm with Henrik Zeberg, Francis Hunt, the market sniper, and Matthew Piepenburg. Welcome back, guys. This is a bit of a follow-up on the future finds that we had in Cape Town. As you can see, everyone, I have also my little Cape Town t-shirt here to honor this great moment. I miss you guys, and it's also the first time that we are able to record remotely, also with so many guests at once. I usually only had one-to-one interviews, and this time is the first interview that on the Microscopic Podcast that we're having with 3 guests. So let's see how this goes. It might be a long conversation, but we'll unpack a lot of stuff because the 6 months have passed, but they have been dense and intense, I would say, to say the least. And my first question to you guys is, what do you think were the most notable events that happened based on the conversation that I invite, of course, everyone who didn't see those conversations that unfolded, that you would say this was the most important inflection point that either affirms or rejects the thesis or the things that, each and every one of you shared. And I would like to start with you, Henrik.
Well, I think when we were there in South Africa, we were in the midst of actually seeing that what would be then the crash and the decline into April, and we were talking about that, whether that was going to be it, or we're going to have a strong bounce from there, or a new top coming. And I think we are seeing that now, and this is the time I start to get worried. And I'm honestly, when I look at things now, and we have Nvidia coming out here on tomorrow with earnings. We have the Fed coming out and doing their cut in September here. I pretty much think that at the time of the Fed here, of the next cut, that's going to be it for the markets. And it's a little higher from here. But so what I would say is the pivot point out of the turn there in April, where everybody seemed to be thinking, okay, now we're just going lower. We saw BlackRock CEO coming out and say we may be in a recession. And my model just pointed to that. It's not yet. We're not there yet, but we are starting to see things coming undone now, and we are getting into the frothy areas of in terms of valuation. We have by far the largest bubble now we have ever seen, and so I think that moment that we really started to rise there, and everybody seems to think, oh, but now things, nothing can hit us and harm us. well, that was the environment I was expecting. So I think we're starting to see that.
Matthew.
Yeah. Look, I got to give Henrik, I thought of him many times since South Africa, because he was very, high conviction that this wouldn't be it. And, coming into April and in the second quarter, that there would still be a melt up. And I thought about him many times after Liberation Day, and his thesis has certainly proved correct. I was looking back at kind of the numbers all of us were looking at back in Cape Town. Gold was at 2,800, then it's at 33, almost 3,400 now. The DXY is down about 9% since then, from 108 to 98. To Henrik's point, the S&P has climbed from 5,900 to just under 6,500, and silver's gone from 32 to 38. And Francis will make the point in dollar-adjusted terms, or gold-adjusted terms, excuse me. I wonder where the S&P really is, but I got to give credit to Henrik. I was a little more bearish, and he was absolutely spot on. It makes me curious and nervous if he thinks we're now hitting to this frothy top. I think he's very correct on that. We can talk about it. In terms of kind of the things that worry me the most since we met, real quickly, I think it comes down to very boring and very sexy at the same time, because all of us on this call right now have been talking about the boring themes for years. Sovereign debt, massive problem there, bond markets, the dollar, the inflation, deflation debate, and of course, precious metals in general and gold in particular. Those are all very stable themes that we've been talking about for years. The magnitude of the risk in each of those themes, I think, has only increased. So that's just a repeat of the boring. The headlines since we've met have just gotten more sexy and, in my opinion, more desperate, whether that's the tariffs, the Genius Act, and the stablecoin ruse, a lot of discussion about gold revaluation or even a gold-backed U.S. Treasury, of course, social unrest and crime, and the drumbeats of war. Those, to me, are the big kind of events that have been happening in the months since we last met. They're all unique headlines. They're all timely headlines, but they all fall back to those same old boring usual suspects, in particular the sovereign credit crisis. We're coming to the end of a credit cycle, which means we're coming to the end of a dollar cycle, which means we're entering a hard asset and precious metal cycle. So a lot of the old, a lot of the new, but still very desperate policies to fix what I think is now an insoluble problem. And that's kind of how I look at the last month since we met in South Africa.
And Francis, I'm pretty sure you have also your 3 cents to add to all of that.
Yes. So for me, the main markets that I was interested in, spoke about in this, was it 6 months? Was it January, by the way? When were we
February?
together?
Was it February?
February,
Yeah.
end of
Late
February.
Yeah. The key thing I was talking about was the target of 3,000 gold to be run. And at the time we were in Feb, we were already part the way on that breakout. And we've now run that key target. The other thing was the ongoing decay of the debt markets. The reason I don't overemphasize stock markets is because we're in a hyper-stagflationary environment. In real terms, the stock market is down if you divide it by gold ounces. And so the key trade is, do you want something that's nominally up but is actually underperforming the thing that is rebased? So for me, it wasn't the highest interesting point, and it was already overvalued, and you could be wearing quite a bad descent as we'd started to face, as we ended up happening in immediately after our February event. We actually had quite a massive crash. So I would say from a trader investment point of view, you had a 27% down on the NASDAQ. I battle with the definitions. I don't think everybody has the same viewpoint on melt up. Melt up for me is when you're in a bull market already at all-time highs, and then you go parabolic, which is very much like the .com. So reverting back and reclaiming a crash and being 7% high on a dollar that's lost 11% to the euro, to me, isn't really a melt up. But there's a lot of people that use phraseology differently. So first of all, congrats to Henrik on his take in nominal levels. But I think the key points and the key markets are the foundational markets, not the equity markets. Equity markets almost like derivative up. So I watch debt. The rates are all higher. The 10-year is in a beautiful setup. I'd love to share some charts, but maybe I should just make an opening statement. Debt year now, US Treasury, UK, all now new highs. Japanese long rate, all at new highs. So the debt system is undermining, and gold has been in consolidation, but it first made those targets we were talking about in February altogether. And I think everybody was on that train and deserves credit for that. further upside. And in fact, we had a blow off high into 3.5, which is probably why we've had a slightly longer consolidation now. But as these rates go higher on the long end, the key thing that will happen is when we get that sudden impulsive move, you're going to get assets, reserve assets displacement again out of debt back into gold. So gold in the longer, not too far off, if the debt markets are about to spill during this season, will probably end up trading higher. So I'm on the stagflation and the hyper-stagflation game. In that sense, you can have nominal assets go up in very poor economies, but they may not be doing so in real terms. So I would focus everybody on the foundational elements. This is a foundational collapse.
So maybe let's then start digging into the debt markets, because you've just mentioned that, and then later on also discuss in more in detail Henrik's blow off top, and also maybe on Henrik's side amend or just kind of explain what exactly you mean by that, and to Francis' point, if it's about like that part of the cycle or not. Would you like to maybe answer that quickly now, Henrik?
Yeah, so the first part was, again, sorry, so you said that, just elaborate on what we see.
Yeah, scrap the first part, because Francis just mentioned about the phraseology of the blow off top part that you might want to react to in terms of definition.
No, I those are facts so far. I may not be, I may not be in the stagflation camp just yet. I think that's something we'll see down the road. I think for now we actually are seeing the rather strong deceleration in inflation, because if we look to the inflation numbers, I know they are suggesting something different, but if we look to all the subcomponents also on the housing side and so on, they are actually collapsing. So I think we are seeing a normal cycle here, simply that we are seeing the end of the business cycle. We see the central banks are starting to come in. We actually have an inflation that is far below than what we had into the 2007 situation, where we had we had inflation actually running all the way up to 5% in 2008. As everything, liquidity actually poured into oil back then. We had in 2001 the same situation where we also had higher inflation. So I'm not really in that inflation camp, because I think inflation is actually more than under control. I think it's actually I am in the situation where we have had an inverted Volcker moment by 2020. That was a complete shift. That was like 1981, and now just from the other side. And inflation is going to rise from here, and the yields are going to rise. But I think we're going to see a very strong decline in yields and inflation over the next time, because the Fed is so extremely late. I mean, it's unbelievable that they have been sitting here and just looking at this, the inflation, which is a backward-looking indicator. It's backward-looking. It's so simple as just to go into, take an inflation chart and then look at it and then see, what does it look like? When would you see actually, which indicators are topping out, and when does inflation top out? And you can see every time and again, inflation comes last. And that's why we see yields are actually now still spiking on the long end, because you're still in that upturn from what the cycle has been onto very recently. But we are now seeing the slowdown, and my model is suggesting that if we have a confirmation here on the coincident indicators, which is the real economy, which means that the job numbers that I said, I mean, I couldn't understand for the last 6 months here what I've been talking to my clients and to other interviews. I said, my leading indicators have been telling me since November that we should be seeing a slowing in the coincident, and it just didn't show up. Every month I was, pounded 270 or whatever they came out with the non-farm payrolls, and I said, yeah, but they can be adjusted by 50,000, and then boom, came last month here, and we just saw it was 14,000 for May and June, which can easily be a negative number also. The adjustment hasn't run all through yet, and I think Goldman Sachs is coming out saying they think there can actually be a rather large adjustment for the full year. So we are seeing an economy that has been slowing for months, or for the half year since we met actually, and the Fed has been talking about inflation until the very recently, and inflation will turn down when this cycle rolls over, especially if we have the largest bubble in the world, which we have right now. It's larger than 1929. It's larger than 2000. It's in the double the size of 2007. And we have in the housing market that is a bubble that is bigger. We have a tech bubble that is bigger, and we have a crypto bubble that is insane. So take those three and then combine it, and then you have a recession coming. I mean, I tell you, the hole that is going to open in the ground is going to be deflationary, and but within not too far distant future, we're going to see the Fed going to be fighting something quite differently here, because they will need to come out at some point. And I think Trump's new man coming into was it May, I think, of 26, I think he's going to do something quite differently there.
This is really good for you and Francis. I stopped looking at the risk assets exclusively when I got into this precious metal space, almost too much with blinders on, but I can't help but want to ask, before we get into the inflation debate, inflation deflation kind of debate or discussion, you mentioned earlier, as we hit to these frothy tops, we're kind of predicting a September 17th rate cut at the soonest, the latest probably October, and you were saying this next rate cut could really be the last hurrah for not necessarily a melt up, to Francis' point, but this final top. And unpack that before we get into inflation and deflation. I've looked at markets since 1980, whenever there was a rate cut in a market that was at least 2% near its highs. And in every event where there was a rate cut, within 12 months, the average return on the S&P was over 10, 11%. That was from 1980 to 2024. This time you're saying if there's a rate cut, and it's pretty much priced in at this point, and we don't know for sure, but it's looking very likely. You're saying if there is a rate cut in September, October, 25 bips, this might be the last dopamine rush for this frothy market before we could become, more negative on the S&P. Am I correct on that, before we get into an inflation deflation conversation?
I think actually I have two outcomes there, and I need to see how it all plays out until the FOMC here. Because if we see the strong rise that I think we could see actually onto the S&P, the FOMC when they come out on the 17th, then that may be it. But and we also have to remember, this is not the first rate cut. The first rate cut was last year, so we have had the rate cuts already. But I agree with you when they start to cut. So we are actually already in that cycle. But I could also see a situation where it actually could send it sky high, and I could see a situation where maybe the first. And again, also it depends on which asset we're looking at and so on and so forth. But I think at least for stocks, there is a risk around the FOMC or in that time frame, or potentially maybe the month after, which then would be in the situation where it just sends it skyrocketing. And maybe even it could be the October non-farm payroll. I want to put one up, little flag up here and say I think there's a good chance we're going to see the first negative numbers on non-farm payrolls in October. And that will then let everybody know, oh, now the Fed is there. So either markets has topped around there, or they're getting close to it, but we are not far from. I mean, it can take, the hyperbolic or the strong explosive part can still happen. And still have up to 7,500. I could see that as a move within a rather short time, but it will be speculative, and it will be driven on the expectation of liquidity, not on the basis of the economy.
Right.
So if we then look at that part as well, like in terms of the inflation expectations, that now also Jerome Powell, the Fed, and now probably all kinds of central banks around the world will agree that the acceptable inflation level is above 2%. So that systematic structural inflation is here to stay. You, Henrik, say that we see a deceleration in inflation. Doesn't mean that inflation will disappear fully. And on the other hand, we have Matthew and Francis, which I believe are definitely more in the inflationary camp. How do you guys reconcile those?
Francis, you can.
Can I start?
In.
Can I start? Just say
Yeah.
I am on. As I said, the trajectory is inflationary over the long time frame. But I just want to say that there is a cyclical nature to things, and we are not in an inflationary environment as I see it right now. We are on the downturn of that, and that will then end up with the Fed coming out with its bazookas, and then you're going to see the inflation coming back. Which, by the way, will also be the reason why the Fed's the weapons or the stimulus is not going to be as effective this time around. Sorry, Francis.
Yeah, so I'll go. People seem to have this notion that it's a binary thing. You either disinflationary or you inflationary. And when you have major currency debate, when you have a debt collapse of 55% on the long end, as you had, you've actually had a fiat debasement collapse. So it goes hand in hand, the two things. They are Siamese twins, as I mentioned. What tends to happen is that you recognize the currency debasement in the lag format later. So you can have very stagnatory environment, which I think Henrik is referring to in his disinflationary emphasis for the average consumer. I think the consumers are wrecked. By the way, we've been calling the economy wrecked far longer than anyone else. We said when you made the recession criteria in 2022 that it was clearly a recession. You don't get to change the goalpost. No one else makes this point. We said the excuse there was unemployment, the great red-hot employment market was a lie, and that's rebasements and later truths would reveal that that was indeed a recession, and all that has transpired. You had 918,000 jobs reversed out last year. You've just in the last 2 months had 258,000 jobs reversed out of May and June. So we've called, when we did the YouTube lies, damn lies and statistics. And when you're in fraudulent debasement times, propaganda and fake stats, estimation, by the way, on CPI is now over 32%. Previously, it was around 10%. So all forms of data. So people that say waiting for the data is you're kind of waiting for a dodgy number from a known liar. We have real anecdotes where people have put in the 2020 Walmart checkout list and checked out with exact same brands, exact same sizing, exact same items, and it's 134% higher, which is 2.34 times over 5 years. That is at the till inflation. But at the same time, what Henrik says is also true in that it's a wrecked economy and the consumer is truly suffering. So we've been calling it a recession earlier than everyone else and calling it inflation. But it's not binary that you have the light on, light off. You actually have the symptoms of both, but what tends to happen is one then rears up and over dominates the other at any one given point, and then vice versa. At the moment, there's quite a few people with the view of disinflationary vibe, and that's what the Fed has now bowed to. He's folded like a cheap suit. Everyone will make a lot of the pantomime between Trump and Powell, and they will say, you see, it's cutting. But can I also just point out, in the week before, the CPI came out at 0.2 a month and the PPI at 0.9 a month, which is an annualized 11%, 10.8 if you want to be specific. So what's actually happening is as tariffs have been introduced, and can I also point out, Powell said it's clearly inflationary and it's clearly growing. That's what he also said at the same time as saying he's going to concede to a cut, which is almost completely dichotomous in notion. So what you actually have, and this is why I keep referring back to stagflation, you're currently experiencing both. It is how you impoverish the people to the benefit of the state. It is debt debasement via fiat currency, which means the buying power and the cost of living standards are disproportionately high on the citizenry, all within an environment. So you have a terrible economic growth numbers, low true employment, and that's being as non-farm fake number, as we've been calling it for a decade, is now being exposed to be exactly that, a fake number to everybody else, is being revealed. Everybody is struggling to know what they hang their hat on. Stop believing the natural statistics and look at the key anecdotes. You are in both, and you should acknowledge both. That's my take. You are absolutely an erect consumer, and I don't know how consumer staples are going to survive this. You've got the most ridiculous overvaluation in the stock market, but a lot of that is based on dollar debasement and debt collapse, where there's not many other places to run. So money is hidden in the stock market into status corporations that continue to win governmental contracts and then be bought up by their excessive weighting by ETFs, which only further exemplify and accelerate and overweight them. So the whole ETFing, the whole status corporate structures of awarding of contracts, the government is now outspending. That's why I continue to point out that we're leaving capitalism where the private sector is the bulk of the market, and that you're moving more and more into state being the core component, and their capital is crowding out everything else. So you've got to look at the balloon that's been twisted. There's an economy for the consumer, and there's an economy for the big contract awards through the big corporate statists who don't pay tax offshore and all sorts of privileges. And there's two rules. You have two-tier justice system, you have a two-tier tax system, you have a two-tier everything system. Corporate system, it's the same in crypto. It's all the status coins that are getting the money that will bring the surveillance grid, and it's the same with the equities. You're 40% of the S&P 500 in just the top 10 stocks. The other 490 eat in another cocktail room where they get cheap sandwiches, and they make up the other 60%. This is where you're at. It's a twisted economy. Both can exist when you have this dichotomy and this polarization of existence.
We have an absolute two-tier honesty system. It's not tinfoil hatted. I mean, again, for years, from 2022 and the recession goalpost to the CPI lie, it's not conspiracy theory to just look at the hard math and the CPI scale, which has changed 22 times since 1980. It's not it's not kooky to say that the inflation data is a lie. The recession data has been modified. So we are already in an inflationary situation. We're already in a recessionary situation. So in a sense, we're in a stagflationary situation. What's fascinating to me, the official concern, the data-dependent myth of the central banks in general and the Fed in particular. I mean, look, if there's inflation concern, they'll say they're going to be more hawkish. If there's concern over labor data, they'll be more dovish. And you can meet those, they can turn that thermostat based on the data they choose to look up. I mean, PCE was up, then you could be potentially hawkish. We'll see what happens. Then there's labor data. That labor data that came in last month, they were looking at 106,000 jobs. It was 73,000 jobs. There was a U6 unemployment spike to 7.9. They can create the data they want. I've always called the Bureau of Labor Statistics, the BLS, the Bureau of BS. And the irony is, for many years, the BLS was so ridiculously pathologically optimistic that when they finally told a little bit of truth about labor data recently, Trump had to fire the head of the BLS. I mean, this is rich. You can't make this up. But the idea that the Fed is data dependent when the data is completely fictional, to me, is in and of itself a kind of a comic tragedy. What the real mandate of the Fed, in fact, if you actually look at the 1913 Act or the U.S. Code, there isn't just the inflation and employment mandate of the Fed. There's moderate long-term rates. That was one of the mandates of the Fed. And to me, the Fed's real mandate is keeping the bond market alive and keeping yields under some type of control, because it's a country, a nation, a system that lives on debt. If yields rise and the cost of debt rises, the system breaks. So this data dependence on dovish or hawkish inflation or labor data is almost music in the background to what I think is the real issue, which is the bond market. The bond market is everything. Those yields are those shark fins. If they don't keep those yields compressed through some form of artificial or direct stimulus, which is ultimately, lowering rates and then bringing out the bazookas, I think the game is over. And I think that's, to Henrik's point, I think we all agree, inflation, deflation isn't a red light or a green light or a zero-sum game. It's cyclical. We can have disinflationary, deflationary moments in a recession or a market correction, but the end game, which is already well in play with currency debasement to monetize debt, and the end game to bazookas fulfill the treasury markets to keep those yields down, is going to be inherently inflationary. So we could see these disinflationary events and the debasement of the currency to get yields under control. The end result is ultimately all roads lead to inflation and currency debasement, because it's inflate or die. I'm simplifying a lot of things, but I think the real question will be just how long the Fed can pretend to manage interest rates or can pretend to manage bond yields before the bond vigilantes or the bond market gets the last laugh. And, the markets, to me, the way I remember them, is very Pavlovian. Higher for longer from March of 2022 to June of 2023. Powell raises rates, the markets were tanking. As soon as January came out in 2024, and there was even talk of rate cuts that didn't even happen until September, there was this giddy galvanic reaction for lower costs of debt and therefore a tailwind for the S&P. And so I think it's how long can you keep this ruse of inflating an asset class by debasing the currency and supporting the bond market to monetize the debt and therefore to control yields, before the yields are no longer determined by the Fed, but by the bond market itself? And how long will these kind of magical tools to keep yields compressed work? I think that's going to be the interesting test. For so long, we've gotten used to the Fed like a thermostat controlling the markets. I don't think they can, and that'll be interesting to see if this rate cut that started already, as Henrik said, can actually keep this charade going. It's gone longer than I thought, but at some point, I think the yields will get the last laugh on this S&P, and I can't predict the exact month, quarter, or policy, but I'll look at those net income margins on the fabulous 7 that are keeping 40% of the S&P's market cap. I mean, it's the most narrow and paradoxically optimistic market I've ever seen. It's more dangerous empirically than the 2008 bubble, which I traded, or even the dot-com bubble, which I traded. So again, it all comes back to me to the bond market, the debt market, these boring old pillars that we've been talking about for years, and an unsustainable fantasy that the central banks are going to be able to control this when we're past the Rubicon now of being able to save the bond market without destroying the currency. That's how I see it.
And that's why I would like to then shift also to the debt markets, because we've also discussed this with all of you, but now more lately with Francis, especially the Japanese yields. I've also spoken about the UK situation with Alistair McLeod a few weeks back, and it all seems that they are all heading and creeping higher and higher, structurally speaking. And as we all know, the bond is a source of universal truth in the world of finance. So how much more does it need to go to be something that cannot be ignored anymore?
So I don't know how much higher they can go, but as I said before, I think what you're seeing now is really the aftermath of the extremity of the bubble that we have, the bull market, the run. What comes again, understanding this, that inflation is the long duration bonds, and yields on those are, you know, a lagging indicator, which means it comes after, it moves after what we see in the real economy. And the real economy is first starting to roll over now. I mean, we've seen that within the last, 3, 4, 5 months. So this about that those yields are moving up is not the same as saying that they'll keep moving up. And I actually think that, we have touched down on a long-term bottom, and we're going to see that we will see a trajectory higher from here. But it's not the same as saying we will not see them falling first. But of course, are making, they're causing problems right now. I haven't followed the Japanese market that close, so maybe Francis will know better there. But yields in general, that is what kills the business cycle by the end of it. That's because yields moving up. And if you look at it also just for in markets in general, you'll see how when the yields are moving up, people are trying to make ends meet, and they will try to take 2 jobs. They will try to, not consume as much, and then they will start to stretch their credit card, balances and so on. And that is the situation we see right now. That's why we are in a situation where the environment is becoming toxic for the consumer, and for a long time that can go on, and especially after when we had the COVID stimulus, because everybody just got pumped up with savings because of the artificial stimulus or extreme stimulus we got, and then they got hit by inflation, then they got hit by yields rising, and that is the situation we're right now. It's the frog sitting in the water, and it's about to jump out, and that's what we're waiting for. When it does, you're going to see things are really changing, and businesses were also building up capacity after. So the whole yield situation is what keeps the heat on under that stove where the frog is in, and all of a sudden you're going to see it jump out. And I just saw an interesting survey here. It's like, is it 15.6% right now that of U.S. citizens that actually have find it difficult to get food on the table. That's higher than going into the 2007, and that is also because, again, yields are up, inflation is up. It's not just inflation; it's both of those, right? And that is the problem. And again, if I could just tie a knot to that, that is also why I think this time is different, because in 2008. First of all, debt levels were not the same by far. We were at 60%, I think, of GDP in the US. Now we're at 20%. Probably the guys here will correct me on that. But we're also seeing, people have seen that, inflation and yields moving up so strongly, which means that even if they're going to save $100 on their mortgage loan or their car loan per month, they're not going to run out and spend that money immediately, which means that will make the whole QE less effective or impotent almost, maybe. So I think the situation really has shifted here, and that is the point. So yields are just, the heat on the stove, and that can go up for some time. It will come down, but the thing is, if we have a secular bottom, which I think we will, then the whole situation, the whole climate is going to change when we see from that moment on when things are going to move up from here. And I think that is the point. I don't think it's the point right now, because we will see the collapse of yields. I don't think new all-time lows, but the collapse of those will come as people start to see, oh, the Fed is going to move in. And if you look at the 1-year government yields, 2 years, and so on, they look like they're lying just on a neckline there. And if it drops there, they will go right a lot lower. And I think you're going to see the long term, they will follow just a little longer down the road, but not to new lows. And then you have a new trajectory. So the yield move up here is a part of the cycle. It's going to kill the business cycle. They're going to kill everything, and then we're going to have the bust. And then you're going to see yields starting to move up, which will make it very, very difficult for a lot of people, especially because I think it's going to be born in a stagflationary kind of world, a real stagflation where inflation will be 5, 6, 7%. And you're going to see that that unemployment is uncomfortably high at 5, 6, 7, 8% as well. So something like that.
All right, friends, I think that's a great transition for your take on that, because I think you disagree on the way the yields are going, especially in the long end, that the short end is being suppressed artificially. How do you see that?
Yeah, I mean, it's good to maybe just run through in charts if everyone can.
Perfect.
I mean, in terms of how did guys do, the people who are watching us want alpha. and they want to be asked how we guided. And I think we guided well. What I don't concede so much it will become apparent. But we were here the beginning of the year, that's March. So we were in this candle and we said you need to be long gold. All of us. So everybody gets a gold star from me for that. Henrik, whatever we differentiate our economic opinions on, he was saying the same, definitely Matthew and myself. You're all better off for being in the gold. That's what's happened during the gold period. Where I tend to come away from others is on this. We were here in February, by the way, in 2025. That's where we were. And I felt there would be an immediate coming quite shortly. And we ended up having a 27% sell-off that rolled into tariffs, tariff tantrum, and a number of other things. For me, regaining what you collapsed is not a melt-up by technical definition. And as I highlight here, we're 6.7% better than just before the collapse in nominal terms in a currency that's collapsed 11%. So when you adjust by any other measure, we were warning here in Jan, Feb, and you still haven't really regained in gold ounces. So the key thing is, what's the best category? And gold's been the outperformer so far, even though it must be said that there's a rally going on now. The high actually for NASDAQ was 2021 in nominal terms. So if we're talking about what's the best market for where we've been, the gold emphasis is the key and the debt emphasis. This is a structural thing. You can play notionally in the stock markets and try catch it, but if by advising people to get out, they missed out on a 27% crash. Only if they'd investors held on and hoped that it wasn't the big one, would they have regained in nominal terms 7% pre-crash, but actually being down more than that due to the dollar's loss of 11%. So I want to highlight that the debt debasement, I feel that this is being missed. Too much power, when I listen to Henrik speak, is being put on the Fed, and this will happen and they'll change rates and all of that. We had that devaluation in the debt market, and we are having that same devaluation on the dollar. It's how the markets work. If I just go back, that's a melt up for me, by the way, on that chart. That's a melt up. You were already at all-time highs on the tech. It didn't matter whether you measured it in gold ounces, which this chart does. Tech was the place to be. And you killed everything. And you killed it for a sustained period, and you had a parabola. And you were already in a bull market that was at an all-time high, and then you blew off. That's the melt up. This is where we are currently, and I don't see them as being the same. So I point out that real terms, you want to be in the better market, and gold has shown that it's actually better because this is 27.51% down since 2021 in gold ounce terms. You should be valuing your wealth in gold ounces. If you're a crypto guy, maybe Bitcoin. But I would prefer to and suggest gold ounces is for these times that we're in, which is debt debasement times. It should be your measure. Those are the charts. They don't, for me, they don't lie. It's quite straightforward. That doesn't mean that the NASDAQ hasn't had a very strong rally, but it's taken back previous territory with only a 6%, as I've already said, with the currency debasement. So let's talk the long-term debt. So I think our counsel that when we were 6 months ago, the beginning of this year, was very good. It was dominant gold and get out of debt and expect higher rates. Now, if we go to any of those long-term charts, US 30-year yield, if in our stream that we've just done, live stream, this daily setup is, again, an upside setup for us. This is a squeeze for higher highs in due course. So we would be trading that to the long side, and we're the exact same on the UK debt. I get to check that view across every market, and I come back the same. I invert the charts to try eliminate my bias of a debt-based crisis. Rates on the long end are going higher. And the people that say, well, never mind the long end, we'll surrender that, we're all going to just play on the short end. Well, no, because the same thing that blew up the long end is now all moving down into a much tighter, smaller space, which is going to require much quicker rollovers. And very quickly, you're going to blow that up. You know, when you're toxic and you've toxified, you know, the bath water by getting in it, going and sitting in a bucket isn't going to stop the same effect from happening. In fact, it's going to happen a lot quicker because the short end is going to require much higher rollovers, and it's going to test the liquidity in that market. So we are in a debt-based collapse, and you have to keep reminding yourself that. And when debt debases, the fiat is debasing too. That is inflation. Whether you are seeing it yet, it's an inflationary event. But at the same time, we are being removed from the economy and crowded out by state. That is disinflationary for you. There's no money for us. There's lots for everybody else. So as I say, they mutually coexist, and every now and then one gets to dominate. Powell is 3 or 4 cuts behind the softness of the country, going right back to the recession, which was under Yellen and Biden in 2022, maybe 4, and he's 9 hikes behind. And the only way you can square that dichotomy of totally contrary necessities is the fact that you're experiencing both, and you're standing in a bucket of ice with one foot and a bucket of hot coals on the other foot, and on aggregate you're at 36.4 degrees, but actually you're melting your one foot away and you're freezing the other one off. That is where we're at. You can simultaneously be on aggregate at a certain level, and that's what the amalgamated fake statistics or propaganda are illustrating, but you can be in deep, deep trouble on both events. That's how I'd summarize where you are. So you need to understand how to fight both, even though they're polar opposites. Do you need a heater because you're cold, or do you need ice block because you're burnt? And the point is you actually need both. But there's one tool that deals with deflation and reserve asset collapse, and it's gold. That's why this whole discussion should keep coming back to gold. You can be distracted by stock markets and crypto pumps and everything else, but if you want to do long-term balance sheet saving, you must recognize that all the forces are already in play, and they can just remove one for a while. You'll suddenly see the other. They're behind each other. This notion that they can't coexist simultaneously is, I think, where there's a fault in everybody's thinking. It's not just US 30. You look at the German. Now, let me just remind everybody, this is all for all the cleanest shirts in the laundry, that the Pax Americano type guys. The US 10-year rate was, let me go back and give it to you, 30-year rate. Let's just do that one. The long terms, we're talking a lot about the long term, is 4.9. That's already 5% at the moment. So Europe is in some ways slightly better, but they've not done the same amount of proliferation. You know, the US printed for the world when they did CV19. The 9 trillion was not just that. There were banks that were bailed out. Many people forget that 21 trillion, which is why I'm kind of amused when some guys say, and the next one's going to be really big. It's going to approach 20 trillion. We already did 23 trillion bailout in banks during CV19. Most people forget that, and it's not well publicized. Massive loans were made. If you look at the German, it's at 3.38. However, the worrying thing for the Europeans is this is absolutely flying up. And now the PM, or Chancellor, I should say, is admitting that they can't continue with a welfare state, as if we all begged him to do it and import all of Africa into Germany. So these rates are going up, and they're going up. They're going to play catch up. But that's why a lot of deals are now being forced where Europe pays. In the Ukraine peace deal, for example, Europe pays, gives the money to Ukraine, who's buying weapons from America. America makes a sale. Europe adds to its debt. Why? Because it's the cheaper debt option. These people are literally funding where it's cheapest, and now they're going to move down on the short end. And you think that's going to give you a long term of postponement? It isn't. There's nothing they save by going to the short end, apart from hiding in every last little corner until the whole floor is painted in blood and you have no place to hide. And we're basically there. They're skimping and floundering. So it's a debt-based collapse. The solution is gold. Play stock markets if you like. We saved you from a 27% shakeout, and in nominal terms, you're still down when we said it's almost here. And you need to value everything in gold ounces. It's that simple, and it's about gold and debt. I like simple, clear messages for people that don't get confused by everything. You want the winner, it's precious metals. You want the loser, it's debt markets and currencies. That's it. Everything else is going to be knocked by the oceans and the winds of these two forces. And sometimes they will have little periods of outperformance, particularly in crypto if they go into the status realms, and other times not. But keep it simple. That's my message.
I couldn't agree more with that. It's easy for me to say hallelujah but that's simple. I mean, in a sense, it's true. I've always said that there's nothing better than a Chanel dress. It's beautiful, it's simple, it's black, it works on a good figure. When you're thirsty, water is probably better than anything else. And when you're really hungry, a simple baguette is far more satisfying than a 4-course meal. And when you look at all these different forces, risk assets, inflation, deflation, currency, it all comes really back to debt, and it all comes back to debasement, and it all comes back to what's an anti-fiat, anti-debase safe haven. And again, it's not just that old analog pet rock. It's just historically confirmed, and frankly confirmed in the S&P outperformance. Gold's outperformed for the last 25 years. So it's not just selling the book. I do agree that a lot of this is fog. We get back to a very simple thing. We are coming to the end of a credit cycle, which means we're coming to the end of a fiat money cycle because they're interrelated. And when those cycles end, gold always gets the last laugh. So it is so simple in a way. People think it's too simple, and it's not nearly as sexy or compliant or as complex as the plumbing in the derivatives market or the FX exchange or God knows the COMEX market, or certainly what's happening behind the scenes. And if you look in the details of the
Totally gone.
Elon doesn't like it. He's like, got him.
Yeah. Okay. Well, we need more satellites, Elon. More satellites. Now he's totally exited the call. Let's wait a few seconds. Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, security saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults, with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. I thought that the starting
views on the yields, if you want to see that, also a few charts, but I'll leave it up to you if you want to see that.
Yeah, definitely. I mean, if that builds up on what Francis was sharing, I think it's great, because then we also have different perspectives on the same question. But let's see what Matt is saying, if he is saying anything.
He had a sketchy internet connection, so I think carry on, and if he comes back, we'll work him in.
Yeah.
Let Henrik go ahead with his point and show us some charts. I love charts.
Yes, yes. Let's eat some charts.
Should I just add it on, or?
Yeah,
yeah. Okay. All right. So, so when we talk about yields, I mean, as I said earlier, I think, we're looking at things here when we look at the short-term basis that is to do with what happened, some months ago. If we look at the really large picture, we definitely can see some structures that is interesting. And let me just see if I can find my my chart here also. Yeah. So can you see my screen? Nope. Okay. I need to bring something like this. There we go.
It's on the show. Yeah, exactly.
There we go. Okay. So this, to me, is the very, very long-term picture on the 10-year yield. And if you look at it here, you can see clearly when you have shifts in the what I call the regime, the inflationary, deflationary regime. And you see here how we have these spiky peaks here in the 10-year yield, and it goes down in the rounding bottoms and start to and become into an inflationary regime. What we see every time is that we have a shift here, very apparent and clear shift into a higher momentum. Simply, this is the market telling us, okay, now we are starting to rally. We saw it here again after the Volcker hike. We saw that then we shifted into deflationary. We've been down for a long time, and now we clearly have shifted into a new inflationary regime. So things have changed. That's what I'm saying. But that is not the same as saying things will just continue like that, because we know that things will go up and down in yields, like what we have seen throughout history, also in this decline that we have seen. So it is going to come down at some point. And if you look to the short,
you can't say it is going to come down at some point. But I have to challenge you there.
Yeah, sure.
Because first of all, that means somebody has to buy more of it. Somebody has to decide debt instruments are worth way more than they're currently priced at, and has to buy an obscene amount. For every small percentage, they have to actually aggressively buy a market where you have China seeking to exit. You have every BRICS nation seeking to exit. You've actually got debt that in Kenya and certain African nations in dollars that has been flipped into yuan right now so that they can have a lower interest rate. The point is we don't have the capacity. All the history you're showing on that chart, we had the capacity to go to double digits in interest rates. We don't at all have that capacity. The whole system breaks. So
that I definitely with
the
you.
historical comparable is not there because there is no demand for the dollar market. Plus a prediction we made that's what happened for Liz Truss happened to America. Trump did a tariff tantrum and actually rates shot up and the dollar fell and money left America. And that's when he backed off. So the whole notion that those rates can only just go down from there is not even fundamentally back. Never mind technically. I challenge you on that.
Yeah, that's fine. That's fine. But what I'm saying is that we have a new trajectory. We are setting up, but I still say from the charts, it looks like to me we're going to have this decline. And when I look at it, if you look at it in a long-term perspective also, especially if you look at what we have going on right now in the U.S. housing market, you see what every time we have a crash in the housing market, we see that in the NAHB. We have had that the same development now at this time here. We've seen how the NAHB, which is a broader housing market
how
index,
many of
which
those
also
crashes were on increasing interest rates?
Actually,
on the
most of them, most of them, because you always have long interest rates going up into this phase here. That's what's happened. That's also what you see here.
You're talking about the Fed cutting. You see, you're talking about the Fed.
But you actually see here, this is actually what happens every time. That's why I'm saying mortgage rates and the interest rates in general, when the party gets going, that's when they go up. And that's when you start to see that the housing market is then starting to take a slump.
It had already started to go down at the top. The top came before that rise.
Yeah, exactly. But that's the thing. That's the thing. And that's why you see what the thing is that when the housing market, because the market yields are something, the short-term end of it will start to rise. But if you look at the yields, they have started to rise from this level on, and they were going higher and higher and higher. And then you'll see that at some point it actually becomes, and if you look at the interest payments for people, they are actually, going higher and higher because people are also putting on more debt, and then all of a sudden they can,
you're working on the cycle will be like other periods of a similar cycle. I'm saying this is all one huge cycle that's ending for the debt-based experiment.
But that's
all of these. We're not going to get the same.
But we agree on that we are seeing a cyclical bottom here, that we're going to see like what we saw over here, that we're going to go up like that. I definitely also see that for the next 20 years or decades, we're going to see something completely different. But what I'm saying is also that right now you have a collapse in the housing market in the US. There are fewer houses sold, existing homes sold, than there were when
you agree on that.
When the U.S. economy was, the population was 70 million fewer people living in the U.S. So the housing market is at a standstill at this point here. And if we know that there is a lagging effect from interest rates, we see how that when the housing market starts to decline, when the housing market
in every event, the Fed had the power to lower rates. They don't have the buyers for the bond market. The 40-year bond bull market is open. Who's going to buy the debt at a higher price and accept
the Fed will do them themselves, obviously.
No,
also.
But that's a T-bill. You see, you've created money and you've created a debt instrument.
Oh, yeah.
Somebody's got to hold the debt instrument for the new money that you're creating. And who's that holder?
And I also think still they will have a run to safety, and you can call it's not safety, but I think you're still going to have it. And also, if you look at it,
now gold.
Safety
is established as now gold. The 40-year bull market for bonds is over, and the sensitivity to interest rates is much higher because the degree of indebtedness is nothing like the 70s or any of those previous cycles.
No,
you have
we
a
agree.
Globally synchronized debt at ridiculous GDP. What's America, 130%? What were they in the 70s? They manufactured things. It was all under control. It is different this time.
Yeah, it is different. I agree. It is different. I just don't think it's different on the short-term basis. And I think also, if you look at it technically here, this is the mortgage loans, that you actually see that you have technically here what is a negative divergence, which you have seen before into the major tops. And if you look at that,
who underwrites that mortgage loan, that has to be a holder of that debt instrument in a collapsing housing environment, in a decaying employment environment.
I'm with you.
What yield does he want for the risk-adjusted underwriting department, given that nobody wants a not-for-profit trade in a known financial repressional era that is a hyper-stagflationary version of the 70s, only much more indebted? Nobody wants to originate debt anymore.
I have to say we agree to disagree on that. I think in the short-term frame, you're going to see that there will be buyers for this as you start to see
if you have cash and
unfolding,
50%.
the unfolding of when the deflationary bust is going to come. You're going to see that the yields are going to come down very, very strongly, and it can also be because of what the Fed is going to do themselves and every other
prices will come down strongly, not the yields. You see, there's a multiple way that this thing resolves. Yields can't go down because you're calling a bull market in bonds, and it's turned. You've had a 40-year end. What comes down harshly is the prices and the ability to afford, and you're left with people, old people that have 50% or more. Maybe 25%, you'll get some financing if you have a great job with excellent prospects that won't be consumed by AI or robotics. That's the key thing that's different about that for me.
As I see it, I think you have a short period of time here where you're going to see that bust, and you're going to see the run to safety still, and you're still going to see a lot of the capital that is still also in the
run to safety will not be bond.
No, but you can be the perception of it still. I think as I see it, there will be a large decline in the yields still.
Corrected 55%, and it's the stock market that's gone up because there wasn't anything but bonds, and it's gold that's gone up even more so and beaten the stock market. That's the pecking order. We are already there. The bond market has turned, and the market doesn't want debt origination anymore. Getting financed, too many bad loans. I don't see that you're going to get that drop in cuts that is going to mean such a bull market for debt. Everybody has learned hard, and you've got the likes of Druckenmiller, Tudor Jones, shorting everything in long-term and medium-term debts.
I'll take them on. They're going to have a short-term spike lower. If you look at all the divergences you see in all the charts in long-term and short-term and so on, you're going to have a very sharp decline in yields going into the bust. And I think it's because the size of the bust that you can see when actually the stock market actually tops out here, not in too distant future, you're going to see that rotation into bonds, and you're going to see the Fed also. So the expectation of that is going to bring yields a lot lower, as I see it. So I don't.
Let me point out.
But I see it on a longer term time frame. I do see that we are in a new trajectory, but I just don't see it. It's not a linear thing. That's
money is moving out of the U.S. equity market into European, Singapore, and other equity markets. If you have a downturn in America, you're going to potentially have flight capital, and you already saw this in the tariff tantrum. That means dollar down.
But that's not up. Recession. That's not into a recession. The recession. If the recession comes to the U.S., Europe is going to be, even worse. So I think I don't think
not in terms of relative valuation of equities. It won't. I'm still not going to be interested in equities. I'm into gold, and I'm trying to keep this simple for everyone in the fastest horse, apart from maybe crypto in fits and starts, but very unreliably so. But if you want to talk equities and equity markets, there is money actively leaving, and American money is leaving America, which is why you're having weakness in the dollar. So if you have a loss of investment in its own country and the end of this crowding out of capital in the unicorn nation of America, because you've got chronic currency debasement, you're not going to get people rushing into the American bond market. You're already.
I just think you're one step too far down the road in terms of what we see, because I think there's still this that you could see the decline in because of the rotation of capital into bonds at this point, and you'll see that kind of decline. But the problem will be the moment when the Fed comes in again and try to stimulate also the economy. I think then you can start to see that the things will change, and you're going to see that the bond market will actually do worse, and that and yields will go up. So I think there is still one turn left, and that's the.
I don't think there'll be a meaningful downshift in rates. Despite that, a 99% likelihood of rate cuts on the long end of bonds. So you may get, nothing goes up in a straight line or down in a straight line. There may be some chop and you may get some sell-off. But beyond where we are by half, maybe a full percentage point, that's the maximum, because you can't find the buyers for that debt instrument, which is the other half of the equation. And there isn't the capital, and it's leaving America now. That's why we peaked.
I don't see that. I probably also disagree, because I don't see the capital leaving America at this point. I think that is the talk of the town. I think that is what we have seen because of whatever people said the tariffs. But what I'm seeing also in terms of my charts is that the Dixie is going to hit 122 into this deflation, and that will not be capital leaving America. That will be capital seeking into America. So I think we are that's where the discrepancy also is. I don't see that leaving. I don't think the U.S. have lost that status. I think it's the talk that we have seen because of everything that's been coming out of the administration and so on. But by the end of the day, it's down to debt. and the debt is 70% still denominated in US dollars. If there's going to be a restructuring, if there's going to be cuts, defaults and so on, you will see that US dollar is needed, and that's why I think you're going to see that going out a lot. And
that's the Shanghai index. That's China composite. It's not the tech index. It's just the general index. I'll put the Singapore up here. We are going to see equity markets going up. You need to adjust by gold to see if they're worth the headache, but they are going up. This is Singapore. Money is in the long term. This hegemony of US stock market period is over. I've called that top at 2021 in gold ounces.
But try look at it there.
You're in the most narrow stock market. This is Singapore. You're seeing money going into the Middle East, the capital formation center of America, with what it's going to go through in terms of debt and currency. I will stand on this and say the 2021 NASDAQ high in gold ounces is going to be the high. In fact, the .com high was the ultimate high. This is the 2021 is a localized high. So let me just explain that. If you divide IXIC, which is the NASDAQ composite, by gold, your .com was peak America, actually. You've already been, you are already quite far in to an allocation more into sound money than you are into tech, in spite of the MAG 7, which is not to say it's been a bad investment all the way. But if you just look at that chart again, and let me just put it on a quarterly, there was that was peak America. Right there and then.
I'll bet you that chart there gives you a new all-time high, or at least
Please note it's in gold down.
Look, you have a bull flag right going on there. So I say you're gonna reach the all-time highs again, and I think that's it. I think you're gonna see that that stocks in the U.S. and you're gonna see that the capital will flow into the U.S. again for the deflationary bust. I think we're gonna see exactly as you say. We're gonna have a massive decline also in tech stocks, as you mentioned as well, and I'm with you also with the sound money, but I'm not with you in terms of the dollar. I think the dollar is going to make a lot of high here, and it's going to be the wrecking ball of the economy and of everything going into, let's say, May of 26. I see a bottoming process that is going on that is probably going to hit down at the bottom around October, and then you're going to see the Dixie actually shooting higher, and it's going to be a massive rally that the few people actually understand.
Well, the dollar has already fallen out of its bull channel.
Yeah, but it did not. It actually down at the level, and that's the thing. And the next level you're going to go to is the 122.
And that's if you measure it, bear in mind that that's the Dixie, which is a hybrid. If you just measure it about its main rival, the Euro USD, and that's not a pump for the Euro, it's actually worse. Let me just get one. It's lower. Let me get FX. Monthly.
But this is, that's where market is a good teacher and a good judge. Right? So we'll see it in, I say, going into mid of 26, you're going to see a massive Dixie rally, and it's going to crush precious metals. It's going to crush Bitcoin. Is going to be completely annihilated. The same with, it's not a safe haven of anything. And then you're going to see the dollar actually, one last time up to the new highs, and then you will see the Fed coming in and actually trying to crush the dollar at that point.
I'd say the macro trends is money moving into commodity nations like Brazil and capital formation nations like Singapore and the Middle East. You are going to continue to see crowding out in the MAG 7 until this bust goes full bust, and we kept you out of a 27% collapse if you didn't take it. But the key thing for rebasing and value everything is the gold ounce, and you should measure everything in lieu of gold ounces, otherwise you should be in gold. And that debt is in a chronic, you take an escalator on the upside, and we've already done 55% in 4 years. What took 3 decades to do, we undid in 4 years. We've just got the final decade to unwind on the debt, and then you're lower than you were in debt valuations, Volcker. And it only goes lower actually from there because we need a full base debt collapse. It's unsustainable. And in that environment, you don't get sudden massive bids. In bear markets, you can get sharp rallies for a short spell, but you're not going to in this environment because it's so big. There has to be so many buyers. Don't count on rate cuts. You should defend yourself against much higher rates, regardless of talk of cuts here. That's my take. And the inflation and the debasement, the real measures, and shadow stats and anything else not related to statist organizations show that the cost of living is climbing chronically at the moment.
Okay, well, we had a nice little heated discussion here.
I missed most of it, guys. I technically blocked out of that whole thing. Scheiß. And
Elon didn't want you to be part of this, Matt.
I blame Elon Musk.
I can just send him a savage tweet. Well, you don't have Twitter.
I really
so...
apologize. I have a few thoughts. I don't know where I got cut off when I lost my Starlink. There was a point where I think Francis was talking about, let's keep things simple. And then from what I understand, it got into a conversation about rates and the DXY in 2026 going higher. And all these different themes about measuring markets, measuring everything in gold terms versus fiat terms, nominal versus real, et cetera, all important things. I'll throw in my 2 cents on this. The first, where I agree with both and where I maybe diverge, ultimately, because I'm not trading risk assets anymore, I'm not responsible for a portfolio. I'm responsible for an investment in physical gold and silver, and primarily gold. My job is a lot easier to give advice to my clients. I'm not having to worry about interim trades or swings, whether it's currencies, risk assets, other assets. I'm looking at gold. And of course, gold doesn't go in a straight line. Nothing does. It's an easier job for me than it is for Henrik or Francis if you're looking at gold in a very innocuous, boring, but essential way as a wealth preservation asset. It just simply holds its value better than fiat money. We save in gold, we spend and even invest in fiat. But gold to us is such an obvious, I don't want to say arrogantly no-brainer. It's an historically confirmed better way to save, just like central banks are doing, just like high net worths are doing, just like family offices are doing, just like sovereign wealth funds are doing. We're saving, hey, just like the BIS is doing, frankly, or the IMF. That gold is the new strategic reserve asset. It's a better store of value than paper money. From my perspective, it is very simple, like that Chanel dress, like a glass of water, like a baguette. I just know I'm going to hold my value and preserve whatever wealth I have in that pet rock analog old-fashioned asset better than a U.S. Treasury, U.S. dollar, or even a Swiss franc. So in that regard, I have the luxury of keeping it simple, stupid, which is a real relief for me. That doesn't mean I don't look at bond markets, yields, risk assets, and the DXY, because it's all related. And it doesn't mean that gold only, again, goes in one direction. I think when I'm trying to piece together what I got from these conversations, I kept getting pushed in and out of because of my internet server provider. Look, I think we are at a credit cycle coming to an end because of the debt addiction from sovereigns to to individuals to corporations. That is clear to me and convincing in so many ways. We can get it and all the symptoms of that cracked debt cycle, whether it was the repo markets, the gilt crisis, Liberation Day, etc., or even the bank failures in 23. The credit market, the sovereign credit market, is broken and it is unsustainable. So if you're coming to the end of a credit cycle, and since currencies are really just credit, and you're coming to the end of a currency cycle, I wish I could have heard more of what Henrik was arguing. I'm sure there's a lot of validity to it about a DXY spike into 2026. I've had this conversation with Brent Johnson, certainly Jim Rickards. Many say there's not enough dollars because of the milkshake theory and the derivative markets and the demand, or you could even argue a flight to US dollar safety and an uh-oh moment in the markets. I don't know if the conversation went there. I'm sorry I missed it. I feel really badly about that. Think for me, it's hard to see a scenario where the DXY, doesn't mean I'm right, goes to 120. It certainly could. That would mean a major spike in yields in the short term, which I could definitely see happening. But if there is a spike in yields, the U.S., Uncle Sam, the Fed, the FOMC, and Powell, whoever's in office then, cannot afford us even a temporary spike in yields to that level that would justify a DXY at that amount. To me, my
yield spread from euro and so on would
right.
need to spike. Yeah,
they would have to then come to that fulcrum moment where it saved the currency or saved the bond market. They would even debase the currency even more, I think, to keep those yields under control and keep that dollar down. The strongest argument against the milkshake theory and a rising DXY is America doesn't even want a stronger dollar. They want to debase the currency in some ways. But even if they did want a stronger dollar, they can't do it. They can't afford the yields. That they simply don't have the ability to sustain this debt level anymore. And what is it 37 trillion? Is it 39 trillion? Is it 40? What point do you realize as a world, I think the world's already known this since 2014. They've been net dumping treasuries and net buying gold since 2014. That increased threefold after 2022 when we geniusly decided to weaponize the world reserve currency, which was already grossly over its skis in debt. I think that was the jig is up for the U.S. Treasury and for paper money. And whatever we talk about with the DXY, we can't ignore the UST when you're looking at the DXY. You can argue about demand for the US dollar, but it's really the demand for the US Treasury and the lack of trust in this weaponized, over-indebted, disgusting beast that the US Treasury is. It no longer has the credibility. That's not just the argument of the gold camp. That is literally what the BIS is telling themselves out loud, and the rest of the world isn't seeing. It's literally what central banks have been telling themselves for the last 11 to 12 years, and no one else wants to see. It certainly isn't what the bond desk at Goldman Sachs is telling its clients in private wealth management when they're trying to sell or flop out 10-year treasuries as part of a portfolio. To me, that's not being a fiduciary. That's just being a salesman. So I think, again, I'm sorry, guys, I missed so much of the argument. I'm just trying to throw in my 2 cents. I'm not saying I'm right. I don't see a scenario where the U.S. can save the currency anymore, given the debt levels we're at. It's that simple. And again,
it's not saving. I think it's not saving it, actually. I think the problem is that that's the debt struggle. But the problem is that the whole world is soaked in US dollar. So it's actually, the problem is that when that has to come unwound, it's, you need to go through the dollar. That's it. That's why it's going to spike. And I'm absolutely with you. You're going to see an extreme amount of printing there to crush it again. So I don't. I think it's really that I get your point, but I just see that things are going to play out because of the situation as it is, and that is going to make things even worse, honestly. So I think
the deleveraging, obviously, if there was overnight deleveraging of the dollar, that'd be like a run on the bank, right? That would be impossible. But isn't that why there's been a slow drip deleveraging of the U.S. dollar, really, and the U.S. Treasury for the last 15 years, and why that slow drip has accelerated a little bit more post-weaponization 2022? In other words, the slow stacking of physical gold by central banks, sovereign wealth funds, the slow emergence of the Basel rules, the slow
Everybody
BIS.
knows where this is heading. Everybody knows it. I know where it's heading.
Isn't it trying to be a controlled chaos a little to keep the DXY from spiking to those levels? I'm not saying it couldn't happen, Henrik. I think you make a very valid point. I'm just saying I think the world's already smarter than the PWM team selling bonds and U.S. dollar measuring of securities and in bragging about the asset price in nominal terms on an S&P, which in inflation-adjusted terms and in gold-adjusted terms is kind of an insult. They don't want to talk about inflation honestly, and they don't want to talk about gold's valuation honestly. But I think there is a need, at some point, as the world transitions from the tier one asset of the risk-free return or return-free risk of the 10-year U.S. Treasury to physical gold, the signs of which seem to be everywhere, that we're making a slow transition from the U.S. 10-year to physical gold. And the question, I guess, you're trying to say is that transition, if I'm getting you correctly, both of you guys may have a different opinion, that transition from the U.S. 10-year tier one to the gold tier one will involve some type of spike in the Dixie for a short period of time. Is that simplifying it too simply?
Yeah, but I think we're thinking in a normal kind of environment and settings. I'm talking about the largest bubble that is going to pop within the next 6 months. Let's say. And that means that a large hole in the ground is going to open up. A lot of that will be, about dollars. It will be about, restructuring and getting, loans closed that has, extreme values or extreme sizes require a huge amount of dollars. There will be a lot of I still see that there will be a lot of, safe haven also in the US. It may be correct or incorrect. We can also agree on that. It could be probably.
But is that based on prior models and prior movements into the safety of the US dollar?
No, not
because
as
now
I see
with
it.
the BRICS and the SIPs and the new systems with Enbridge and what's going on outside the system.
Which currency which currency else suggest that we should kind of end up in?
I think there won't be.
What is the
cleanest? The real, the ruble, the rupee, or
the euro, not the euro either. I mean, talking about no, not the euro. So it's still. I mean, it's maybe kind of dirty, but it's still the cleanest sheet we got. The dollar.
No,
unless we go to regional settlements with gold filling the delta in a reset moment of which will blame on extraneous events.
But that's a monetary reset you're talking about. That's a completely different setup. What I'm talking about is the transformation. That's the process that gets us to that point where we say, oh shoot.
Right.
And we also know what the Fed is going to do with the dollar hits what I'm saying Dixie 22. And I will say Dixie.
Where would the yields be when the Dixie hits 120 then? Where would yields be?
The spreads are going to be, quite crazy, right?
And how long could the US sustain those spreads? For 20 seconds?
Not long.
20 minutes?
Exactly, but that's the point. That's exactly the point. That's why the Fed is going to come in both, shooting at both bazookas and whatever else they have.
Right.
So I think the transformation from this to the sound money that we all agree on, and where I think you're going to see gold and everything else, probably also something with digital element to it. But the monetary reset that we're talking about is going to come at some point, but that will be something that is manufactured, a deliberate kind of thing that they're going to set up. But that is not in an environment as we're in right now, because right now they still think that they can just, if deflation comes out again, they can just put money on it. When what will happen, we'll need to see some kind of stagflationary inflation.
But the beautiful thing is, regardless of the academics, I'm not saying it's academic, it's very well thought. And I'm not pretending that I know the answer or any of it. We have strong views on the DXY, and any of us could be right or wrong, but we all agree. I have the same conversation with Brent Johnson. I have the same conversation with Bitcoin folks. I have the same conversation with traders, but we all agree on one thing. Regardless of a spike or a stalemate or a decline in the DXY, and regardless of where rates go near term or short term, if you're looking beyond speculation month to month, day to day, week to week, which is a very different game I have to respect, for me as a gold investor, I'm almost agnostic, because regardless of those spikes, the end result for me is very simple. It is a debt crisis that is now past the Rubicon of being solved. It is currency debasement that is inevitable as the sunset. And it is a clear direction by the sovereigns, the major banks, even the ones I'm not a big fan of, that gold has a new strategic role in whatever the new abnormal chaos to come or organization to come. So I can afford to almost be right or wrong on the DXY near term or short term, or even inflation or deflation near term or short term, when the long term for me, unless a meteor comes from outer space and quadruples the gold supply per hour for the next 3 months.
Only you don't want the Dixie 220. And if I get it right with the Dixie and I get it right with the deflationary bust and the largest pop of the bubble, you're gonna see a 40% decline in gold as a minimum,
which you would see as a buying opportunity, I assume. And this is where, and this is what you've been arguing.
That is the buying, to me. That is the buying opportunity, and I'm completely with you guys. That this is the, you gotta go to gold. You gotta start thinking of it.
Because you've argued that this, like in 2008, we'd see a 30-40% retracement in gold in the next moment on the S&P.
Yes.
Can I enter here? Why it always frustrates me that the key positioning gets dwarfed by the possible minute, only could last 20 minutes, 20 days, super spike in a structural sense of a dollar. And I consider this the success of Brent Johnson proliferating his theory, when the primary position is absolutely 100% gold. And people who think they're going to time this, when such an event would occur, you're probably losing. Where's your money? In a bank? You're probably losing your money in a bank. Where's it going to be? You think in a T-bill? And that you're going to be able to sell it. You think payment systems will even be working. We're talking about counterparty risks, so many, very, very many things. And then there's so many reasons why it might not happen. I'm not saying it can't or it won't. We have a setup against the USD Korean won that could come or could not. It might be all on the Koreans. It might be the dollar spike. We don't know. But you're going to treat that as your play, when instead you should just be focusing on one simple. Most of our people watching are investors. They're not day traders. And the message really should be simple and straightforward for me. And there's a number of reasons why that I will give you. And I'm not saying the dollar spike won't happen, but there's a couple of reasons why it might not. You've already seen money leaves America. And when that happens, you get a rate spike. And instead of everyone assumes a rate spike on the dollar, which is actually collapsing of the debt, means immediately the dollar goes up. You just had the perfect example in April where it in fact crashed on rate spike. It crashed. That was money leaving America. And when you get currency debasement and highly unstable, over-indebted situation, money leaves. The people that have crowded out into the Mag 7 move somewhere else. And I think you've already seen this leaking into other indices, because I've shown you in gold ounce terms and in other indices that are better set up with technical setups than now the NASDAQ, which is ridiculously overexpensive. What happens to things that are ridiculously overexpensive? They get cheaper. They fall. It's a terrible time to be buying the NASDAQ. Even if you get a technical notional increase, it's not a terrible time to buy gold. Everything comes back to gold. There's a couple of reasons why the spike could not occur. The Japanese yen is actually the cheap wholesale financing system for the casino in America. As long as the yen keeps weakening, you're fine. If it breaks that 140, 142, you'll have a much larger version of what happened last year, August. And that actually was crash in dollar, spike in yen. As you've already seen, Trump tariff tantrum, rates can go up and the dollar doesn't go up. It's a loss of confidence trade. And that's where we are. It's end of empire. You should be more braced for a loss of confidence trade than one that's going to lead to a super surge, no matter how many dollars are offshore. I've just explained that nations that are borrowed in dollars are actually getting swaps with China. So America is taking the dollars they don't want and can't do anything with, paying off the loans that African nations have incurred and say, have it in one, and they've now secured resources. Everything is an anti-fiat, anti-debt trade. And trying to time for a possible spike that might not happen, I think, is a fool's game. You're in a debt debasement environment, which means specifically on the dollar. The rates are one of the highest outside of the UK in a tier 1 nation, and they're the most indebted. And with the debt debasement is the fiat debasement to the highest order. We said the dollar will be weak. I said that, and actually with this crash, you're now 11% down on the dollar against other weak currencies. The ruble is 42% up against the dollar. The Hungarian forint and the Czech krona are 15% up against the US dollar. These are Eastern European nations. They also have minor debt issues, but not to the scale. The hegemon falls off a 26-foot ladder. It's always like that. Ask the British Empire. And that was a friendly handover to America. This one isn't. Everyone else is standing on a 3-foot ladder. This is going to be very dangerous, and you may not get your.
No, I think you make it. Look, and I tend to agree with you, Francis, but we have to give Henrik his due because, and we have to give Brent Johnson and Jim Rickards their due too. It's not. I think what we can all agree though, before we can get lost in the DXY debate. It's so complex. I mean, I had the debate with Brent Johnson 3 years ago. For those 3 years, I get the pride of saying I won, but the game isn't over yet. It could still change, and I think what Henrik is saying is valid. For me, again, I'm still agnostic because I started buying gold 20 years ago. If we have a 40-30% dip in the next market crisis, I'm relatively using that as a buying opportunity. But smugly,
but hold on, you have the notion that we'd have a 40% drop in gold. What do you think?
I don't think we will. I don't think we will. But we have to. We have to. What's that?
What is China? The gold is running not because of you and I. It's running because of central bankers.
That's my view too, Francis. I agree.
If the treasury market is doing, and the dollar is doing what Henrik is saying, and you're having a 40% drop in gold, if you even just get to a 20% or a 15%, what do you think China and Russia are doing with any dollars or treasuries they hold? That's amazing. Thank you for the liquidity. Have it all back. These guys, China is a patience trader. They are not a trader. They're a patience investor. They sleep on the riverbank and wait for the dead bodies of their enemies to come by. That's
why I think it's ultimately
that will absolutely unload everything into wherever
I agree.
the liquidity is coming from. So how do you get a 40% collapse with all the major central banks, probably including Switzerland, which is supposed to be a friend, but has also been accumulating gold? Every major central bank, which is the key move the needle gold buyer, on a 40% drop. So we're at 3,300. You're talking 1,700, 1,800. Great. They're going to load up and they're going to get rid of all those treasuries. They'll be doing it long before you get that 40%. And I don't think it tops yet.
I think it has a little more a higher move than before we top, but I think the top is in around 3,700 or something like that. And then I think you're going to see with the Dixie spiking up like that, you're going to see a very large decline. And again, into a deflationary bust like what we could see here, everything is overvalued. We agree on that. Everything is overvalued.
Who's selling the gold and who's buying the treasuries?
But it's not. It will be about. Trader? Because you'll also have a situation potentially where there will be, you had a situation also where gold actually dropped because there was at least the rumors said there was a hedge fund, in problems and they had to go sell gold and you saw a large decline in that gold. I can't remember when it was not so long ago. So things can happen. If the floor opens up and a lot of people are starting to lose their money on their crazy crypto investments or whatever it's going to be, or their hedged, long,
that's retail.
Leveraged.
That's not central.
No. But
this is good. This is good. This is good because it's important to have a disagreement on the DXY. We agree on gold.
What we're actually saying is crypto kiddies that are losing money on crypto, who happen to be big gold holders, are now going to be selling their gold, and they're going to crash the gold market in an environment where the central bank
sovereign state. It can also be sovereign nations that can be in problem. Can get a problem if you start to see that they're the yield levels are
but Henrik, are you saying that in this event where the Dixie spikes in this short-term window of shit happens, excuse my French, is that going to be driven more by a need to sell gold for liquidity, or driven more by a need to buy U.S. Treasuries as U.S. dollars for safety in that moment?
I don't think there's either or. I think there's there'll be a plethora of things. I think it'll be driven by the need for liquidity, and the only real liquidity is where the debt is denominated in, and that will be denominated in dollars. You can't pay off your debt with gold. You need to sell gold, and the thing with gold is that it's fantastic to give you liquidity when you need it, and that's what it's there for. So you'll probably see that the sell-off will be something
what happened in 2008. I'm just trying to find
arguably, which is the 35% decline.
Unlike 2008, I'm just trying to. I'm not saying this isn't a foolish argument.
No, that's fine. We just
unlike
discussing.
2008, though, today in 2025, the mood, the need, and the status of gold, not just in the headlines, but literally at the BIS, literally at the Fed, even all this nonsense and discussion about gold-backed U.S. dollar again, and not to mention revaluation, not even going down those rabbit holes. What we're seeing with the use of BRICS gold as a trade settlement for net settling, what we're seeing in the oil trade, what we're seeing with the stacking of physical gold in the East, don't you think the environment from the BIS to the Shanghai Exchange to the SPYMEX in St. Petersburg is so different now than in 08? Maybe you could argue that's even more reason to dump the best asset in an moment.
I'm not sure. I mean, I'm not sure. You know, what is not different here is that you have a bubble that has a size that we don't even know. We don't know the fallout of this. If this is going to happen, as I see it,
of the carry trade. Why aren't we talking about a yen spike?
But even before we look at the carry trade, look at the U.S. Treasury today versus 2008. Again, if you're using 2008, which I think is a valid comparison, but the U.S. Treasury is so less loved, so less trusted, and so much further in debt today than it was in 2008, that it is no longer the safe haven that it could have possibly been in an 2008 liquidity need, where gold could be. But I'm still saying, the real issue is
beta, Matthew, was 4.3% during the carry trade crisis last year. That's how much it lost. Bitcoin lost 30%. This is not a very low downside beta at the moment. The buyers and the money shows up. The buyers and the money shows up because the rest of the world outside of America is already planning for a held gold, at least backed in some way, even not implicitly stated by who holds the biggest gold. And we all suspect it's China, which is the 2,500 ton number, which is probably more like a 50 going on 100,000.
Poor Henrik, you're on the block here, Henrik, and I'm not saying you're wrong. I think this is good. You've got the cojones to take a stance here, but to Francis,
I'll bet you a dinner in South Africa.
Okay, if in your model, how much gold does China really have? And it's not what the World Gold Council has.
But
so in that,
I think you're making fundamental and rational talks about why it would go up. Am I disagreeing with that? No, I'm not.
Right.
But do I think we can have a liquidity situation where things can be sold off? Yes, I do. And if I look to the price of silver and I look to the price of platinum and so on, it's nowhere near where gold is.
So the whole thing market being bid up.
One second.
Francis, let Henrik finish.
One second. Yeah. So the situation is also that everybody has been front-running his whole narrative that you're now talking about. And silver and platinum and the gold miners, somebody forgot to send them the memo, by the way. So I think you're talking the narrative of gold, and that's why I'm saying gold is in and now I put it, a mini bubble.
Right.
Because everybody has talked the narrative up at this point. I agree with you. See, it will change. It will change down the road, but you're going to see that oh shit moment where liquidity will become everything.
And you could be
and
right,
that is
Henrik,
where you need
what if gold is not in a bubble at all? What if gold is simply doing what gold does best, and the only thing that's in a bubble is the US dollar or the yuan or the yen?
Somebody should have told platinum, silver, and GDX.
I think the GDX, I think platinum, platinum's another conversation. I think silver always is the little speedboat that can once gold hits a bull market, but gold isn't in a bull market yet. That's why silver hasn't taken off.
But I think silver actually looks even worse than that. If you look,
it's amazing to me that we're talking about a gold bubble and not a debt bubble.
I have to agree.
Amazing.
We have a debt bubble. We have a debt bubble.
I think if anything, we have gold undervalued, and we have a
major undervalued.
Let's first hear what Henrik has to show you.
Okay.
Look at this.
Poor Henrik.
We have all-time highs on gold. We know that, and we also know that normally when we have a real gold bull market, we will see silver follow. Silver is not at all-time highs yet, and there's nobody who can tell me technically that this looks strong for silver.
Early stage.
No. This is actually late stage. This is late stage if you look technically. You have that the silver is making lower highs on a weekly basis when it moves higher. That tells us that you're moving into a level where it's probably, and I'm saying it's around 41, 40 something, 42 maybe.
Yeah, but that's
where
a
you're going to
different
see
point.
a decline.
I also see silver being rejected in the 40s before running 50.
But this is actually a very big rejection. And it
No,
just
but I don't see
doesn't
it
make sense.
being a big
It
one.
doesn't make sense. It doesn't make sense that, but gold should just keep moving higher. And silver, by the way, gets rejected at levels which are far lower than the all-time highs. And by the way, minus does the same, and so does platinum. So what if the most rational explanation is actually that gold has been front-running things a little here, because everybody's been talking about inflation and how debt is a problem, and that debt is a problem.
Devalued. It's artificially devalued.
And that is why it's going to have a relative larger pullback when the Dixie is going to, when we go through this whole shit.
There's an industrial component to silver, number one. And
that's my perspective.
I get your perspective, Henrik.
That's my perspective.
And hyper-stagflation, there's an industrial component.
We're not stagflation now. We 2.7%, there's no stagflation.
We are absolutely not getting consumer buying. So there's not the same.
But we have 2.7% inflation. We have 2.7% inflation. That is low historically.
You've been
very, very low.
A number of 2%.
But you don't actually believe that's the real inflation number. And silver priced in gold terms is still very cheap, as is platinum. And technicals, you guys are far better than me, but we're at a 45-year cup and handle for silver. I think silver's just waiting for gold to actually have a bull market. I don't think it's a bull market.
No, it's not. But even bull markets have large pullbacks, right? And
that's what I'm saying. I just want to be clear, because I'm not making fun of it. By the way, there's no doubt I have huge respect for you and Brent Johnson and others. So I tend to agree entirely with Francis. That's easy to team up on you. But if I want to clarify that you're basically saying gold is kind of itself in a bull market, maybe a little bit inflated, hype, front running, and that the real, and I'm simplifying that, when there's a real moment, that there'll be an 08-like sell-off, because 2025 is very similar to 08. I would argue it's different. But if you were to change your thesis, it's a little bit, if you could think of, and maybe you don't, that it's not that gold is in any kind of a bull market. If anything, gold is doing what it always does, which is nothing. It just sits there. Well, fiat money is very busy, and sovereign debt is very busy debasing fiat money. And what we have is a major, I think, fiat bear market, and a bull market for gold is simply waiting for the fiat to die.
That we agree on.
But you don't think there's a difference in degree? You still think the gold is overvalued given the level of U.S. or global debt? You still think it's overvalued?
No. I think, as I said also, I think gold is going much, much higher. Yep. I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I just want to say, like when I'm talking to Bitcoin guys also, I'm saying, guys, I know the saying of institutional adaptation and all these things, but by the end of the day, I think it's a bubble. Okay. And I think that's the way it is. What I see with gold is that I think gold has a fundamental and it's going to also, if I look at Bitcoin gold actually ratio, you can also see that there is something to that. Bitcoin was outperforming a little more, and then you're going to see gold actually taking over again. If you look to the SPX versus gold, you can also see that we have a similar situation like what we had in 1929, in 2000, and in 2000 actually, and also 1971. Sorry, also with Nixon. So we have a unique situation here where yes, gold is going to outperform in the longer time frame. That is if you take the dollar out of the equation. But that's not what you can do in a deflationary bust, because that is when the dollar is everything. The dollar is everything, because you need to pay your debt. So if I get it right,
when you say the dollar is everything, you're saying the debt instrument is everything too. You've got to talk about both. Who's buying the debt? Yeah, but this is a gold bubble, apparently, according to you, at the moment. How can you? I don't see how technically you can say that. We haven't even reached 2000. The 1980s
no, I'm not.
This is adjusted for the fake statistics that you like. The BLS, these are their stats, dividing by the CPI. And that's where you are. You haven't even met the CPI adjusted high of 1980. And we are in 130% of debt in the United States, 39 trillion, where we were compared to in 1980.
But these are fundamental things I don't disagree with. I don't disagree with that. And as I just said, $35,000 per ounce. I mean, that's the highest number we have heard on gold today, right? That's my target. But what I'm saying is that does not rule out a 40% decline into a deflationary bust where the Dixie can go to 122. It does not.
And what will lead that Dixie to 120? Because there will be such a need to get liquidity to pay off dollar-denominated debt. Is that simplifying?
Everything.
As opposed to maybe just defaulting on that debt or selling treasuries.
But still, you have to settle that debt somehow, right? It needs you need to settle that debt somehow, and it's not just a simple thing. you know, it's a housing bubble. It's a crypto bubble. It's a tech bubble. There's so many things that are going to blow up, and I think
is
that
gold a bubble or just the best asset in an moment?
Of course, it's going to be a fantastic asset at some point, but there are different phases for things. And what I'm saying is a deflationary phase where liquidity will be everything. To pay off things. I don't think gold is the best. It's the best time for gold.
No one's going to buy.
Would I buy it? Would I buy when it comes? If it's answered, yes. I'd rather buy it on the sentiment where people are saying, "Oh, I don't want gold,"
right?
Because it's just, you know, and I don't think that's the sentiment we have right now.
You can't take rate cuts without some aggressive buying of the bond market. Who's going to rush in and buy all the US issued bonds in an aggressive way that it pushes prices up immensely, sufficiently for you to have that dip in rates that's going to lead to a 40% correction in gold?
We've seen who will go out and buy this in previous times. That's still there. As I said, also, I don't think you're going to see a new all-time low on yields, but I think you'll still see that people also will run to the dollars and to the U.S.
But if you're wrong on that, you may be right. I'm not saying I have the answer, but if you're wrong on that, then you're missing out on a chance to. If you're right, you're waiting for the right time to buy at a good value. If you're wrong, you're missing out a chance to get something you think is going to go meaningfully higher, because there is a very
right now Bitcoin.
Right
now, Bitcoin is outperforming gold.
Yep.
So I'd say, so that's why I'm into crypto camp. So you can say, we can always point to another asset and say, I just think that would be a better time to buy gold. That's it. Am I disagreeing with you guys fundamentally? Not at all.
Right.
I think you're absolutely spot on. And I think gold
is more
will
the trader's talk.
Yeah, it really is. But it's a very important talk. It's a very important talk.
But you also narrative that shakes investors out of the right positioning as well. And
no, because actually, I would say the opposite. Because if you talk yourself into to go long gold, and I am right, then people say, "Hey, why do I buy this?" And if you ask Warren Buffett, he'll say, "Why the fuck do we buy something that we dig out of the ground and didn't dig into the ground again in a box, right?" So I'm just saying that a decline like that could come if I'm right on the Dixie.
Why do you think, and again, I'm not trying to challenge you, I want to think this out because it's important to me. It doesn't change my view on why I'm buying gold now or why I'll buy gold next year or 5 years from now. But if you're right, and there's going to be a meaningful value buying window at some point when the DXY spikes and gold falls in an 08 like kind of rhyming historical moment of I think 08 and 2025 are very, very different. You could argue they're going to be just polarized. That's a fair point. Yeah. Why would central banks, the BIS, or even sovereign wealth funds were relatively sophisticated, and certainly in the East, relatively sophisticated in what they think of the U.S. Treasury, the U.S. dollar, watching very carefully as we fumble through a checkers match with our currency? Well, they play chess, stacking physical gold for decades without reporting to the World Gold Council. Why do you think they'd be running through London and New York and these exchanges and creating these exchanges in Shanghai and in St. Petersburg if they thought the real buying moment was later? But do they?
Do you think the central banks are good traders?
No,
was it the UK? Was it the UK who sold it in 2003?
No, I'm not comparing Gordon Brown
Canada as well.
So let's just put it like this. I don't see the central banks as the absolute top
I'm talking about
the
East,
world.
Not Gordon Brown or not the Bank of England, or not the Fed.
I think
the Fed isn't buying enough gold.
What I'm saying is that what I'm saying also is, I talked to somebody else. I said, I think Europe should buy much more gold. We should also stash up around the euro to make sure that we have because it'll be a time where we'll say, show me yours and I'll show you mine in terms of how much gold you hold.
Right.
And that will be the moment.
Can I make a short closing statement, and then I really have to run personally? I'm on the shot. So here's my take. There's a lot of reasons I think this is a dangerous discussion. I think it shakes people out of the core holding that should be an investment, not a trade. On top of the fact that there may be a dollar spike, we don't know how deep the yen carry trade. It could be the yen that spikes when America has to repay back all the loans. You don't know the underpinnings. There's going to be many turns. We can play guessing games on all of this. First, for you to get a major collapse, such as 40% on gold, on the basis of everybody suddenly needs dollar means, and rates collapses means everybody's rushing into treasuries. You can't mention the dollar without mentioning treasuries. If you think the dollar is going to get strong, you need money that isn't already in America to be flooding into America and buying treasuries. Why can't they buy other debts? The German debt is cheaper. It seems it's priced as less likely to die. I'm not recommending any debt, actually. The position is gold. Stay with the position. You're in a debt-based crash, and the hegemon is the most indebted of them all. It's not the cleanest shirt at all. You can see from its rates in tier world nations that outside of the UK that's just jumped ahead of it, it's the one that's going to collapse. It falls hardest when you're a hegemon. These are the summary points that I want to get out. The dollar will crash with the debt crashing, no matter what little engineered volatility comes along. Position for the main journey and make sure you make the main ride. The move will make you your wealth. Try get too smart, you're going to miss this. You're going to get caught out on unobtainium. You're going to get caught out trying to buy on a 40% dip that never comes. All sorts of things can occur. Debt-based crash is a fiat-based crash. It's really that simple. The anti-fiat trade is gold. You buy gold, you are actually anti all fiats, and particularly the hegemon fiat. That's the dollar. That's the key thing. Hold it. Don't get shaken out. Don't get confused by clever narratives and possible scenarios. Stay the course. If you're buying monthly, you will dollar cost average. Stay the game. This is the winning hand. That's it from me. I do need to go. Love to see the other guys.
Hi, Francis.
Cheers to Henrik. We hope to take down. Cheers to Matthew. Thanks very much, guys.
Hi, Francis.
Great fun. I look forward to the
Thank you, Francis.
Now, obviously, I've got to support Francis, not because I'm selling my book or my bias, but I do agree with Francis. That doesn't mean that Henrik isn't. I don't think he's trying to sell a foolish narrative. I think for any of us in the long or short-term gold trade or investment, we have to look seriously at these arguments, not as tricks to sucker people out of the gold market. Because I think Henrik totally understands the gold market and believes it's a strong investment. He just sees a potential better value play post a Dixie boost, and I think he's not alone in this argument. I can't just be a fiduciary in the gold space and say gold will never have a serious retracement, that it's impossible, that there couldn't be a scenario that Henrik has put forward that's plausible. It is plausible. I do tend to agree that you can't look at the U.S. dollar without looking at the U.S. Treasury. I don't see it very similarly. I would agree that there could be a major sell-off in gold to get liquidity in an uh-oh moment in the risk asset space. The degree of how serious that could be is up for debate. I don't think you're wrong to suggest it could be significant. I don't think you're wrong. I think Francis believes wholeheartedly that you're wrong, and he's got a passion for it. That's what makes a good debate, and I think he's a great guy.
Yeah, that's fine. That's absolutely.
I'm sorry I missed 80% of it dealing with Elon Musk satellites, but I really wish I could.
All good.
But I think for us, whether it's a near or long-term play, it's absolutely essential to own gold. I think you make a strong case of, well, look for your buying window. We've been buying gold since it was $300 an ounce. We were relatively agnostic as to when, but that's very smug if you've already got a lot of gold to say, I don't care, when people are just getting into the space now and they do want to get value on their gold and not pay 40% more than they should. I think that's why Francis is worried, because he worries that arguments like yours might get people to be too confident they can wait for a better buy. But if you're right, that's absolutely good advice. I think it's sincere advice. And so, it depends on where you are in your gold buying cycle. It depends on where you are on this conviction. You can't dismiss it. We can't dismiss it. We all talk about what would happen, what will happen when markets mean revert in a significant way. What will the sell-off in gold be in the near term? Of course, there could be a real risk of that. I don't think we could laugh at that argument you're making. I just don't agree to the degree of it. But of course, I have a bias not to agree with the degree of it. So I don't think we can dismiss it. And Rickards and certainly Brent Johnson see a much stronger dollar before a weaker dollar down the road. And that has been debated since I started thinking about precious metals 10 years ago. So I think these are absolutely important discussions. What's interesting, though, is despite the nuances in the near term, I think we all see a longer term obvious play in this. And I think we can agree on that. But I think what good is a discussion if we all agree on everything? I think it takes a lot of courage for Henrik and Brent Johnson. And what Brent said to me when I had this same debate, it's one thing when you're just running a gold business. That's fantastic for you and Egon and the guys, because it's pretty safe, it's pretty smart, and you're doing the right thing. When you're measuring or working a portfolio, and your performance monthly, quarterly, annually depends on where you are with the DXY, what you think of these risks. It's a much harder responsibility. I respect that. It's much harder to run a fund than to run a gold preservation, wealth preservation, white glove merchant bank, which is what I'm doing. It's basically just deposit in, no hypothecation, preserve your assets, stay out of fiat, hold your gold. I think for Henrik to have these views, he has to have these views because he has to look at things month to month, quarter to quarter, cycle to cycle in a different way. Francis, of course, would say he does the same thing, and I don't want to dismiss that. But I think it's I don't know, it's a long-winded way of saying we need to have some disagreements in the gold space, and I don't think it's a foolish argument that Henrik is making. I just don't agree with it. Of course, I don't, but I could be very wrong, and I admit it. And so. These are challenging things for all of us to think about. I look too far at the 30,000 foot level sometimes, and I need to come down and consider these things.
All right, guys, I think it's been exactly the type of conversation I was actually expecting. We got of everything, and if there's only one thing we can all agree is that it's good to have also a different perspective on the market.
Absolutely.
That makes us sharper, that makes us also look beyond or like the environment that we usually used to.
Yeah.
And I also invite, of course, every viewer and every listener to always stay critical to whoever says whatever, and to be able to reconcile also. Sometimes intellectually challenging to put opposing ideas together and to think about those things. But one thing is for sure is there's nothing as good as gold.
No. Long term. Absolutely not. Absolutely not.
Absolutely.
And the Bitcoiners will disagree on that. But
yeah.
That is for another day. Is there anything else that you think is very important that you two want to share to round off this conversation?
I want to say that I think, and I want to say that I think we are at a very, very crucial point here now. We're getting closer to that top of this, what I call the everything bubble. That is, and I actually finished a book also that I'll send out soon, or actually publish soon on this. Which
you're writing a book?
Yes, it's called The Monetary House of Cards, the bust of the everything bubble created by central banking hubris. And I think that, right on with what we've been talking about here is that there is a big shift coming. And what we saw in 2008, people said this is the great financial crisis. It was like the First World War was the greatest one until the Second World War came along. That's where we are at now. We are at a peak of things here, where things are changing because of the chart also that I show, where the long-term yields are now shifted into to a new regime, which is a serious thing. And I think that the geniuses and the Fed is going to think that we are going to just pour money on this again and then all will be fine. It will not, and it will change dramatically. And that's why gold has a very, very, and I'm dismissing people who say that, Bitcoin will have that position. No way it will. There's no chance, and Bitcoin is going to crash horrendously. So the gold case is there. What we're discussing here, I just want to lay that out clearly also, is what and when and how. And I'm saying, and I think that the gold is the what, the when is probably a little later for me, and how is built the physical gold, and also to me actually also maybe buying gold companies, shares of that, I think could be a good investment also, but down the road. It's only the when we're talking about, because as I said, 35,000 an ounce, and I mean that seriously, in the next 8 to 10 years, is easily seen if the situation that I see from a business cycle angle is going to unfold, because they're going to flood the world with another liquidity, and we're going to see stagflation, and it's the real stagflation, which is this 5% inflation, 7% to 7%, and unemployment at 5, 6, 7% also. That is the time where silver and gold will go up like, in a rocket speed. And they really haven't done that this time, but let's see about it. Let's see if we get the win right. But it is the solid foundation of countries, and that's why also we see the whole East are buying up, because they look at it in the long-term perspective. Like Matthew.
Yeah, no, and I
like old wisdom, they do. They just buy it for the long time frame, right? So.
Yeah, and again, I don't want to look smug, because I think it is easy for me to say, or for Egon or our clients, but I think it is for many people. There is a sense that gold is very expensive. If there is a chance and a legitimate argument to be made that there's a better buying opportunity, they have to look at that perspective. You give a very strong case for that. Francis is worried that may lure people away from doing it now, because he has strong conviction that won't happen. So it's a very important conversation. Who am I to say who wins? We all agree. I think my final words are this, and it has nothing to do with the DXY, yields, bond market, cup and handle formations, charts, all of which are very important. I think it's important to end on a simple thing that reminds me of when I was in high school. It's a story. When I was in high school, I won an award to go to meet this professor. His name was Paul Kennedy. He was a Yale professor. He wrote a book in the 80s called The Rise and Fall of the Great Nations. It's a book that no one would even read today. This was 1980s. But, it was interesting. He sat down with a bunch of us young high school geeks who won this award. And this was in New Haven. He said, you guys are all probably going to go into Wall Street. I know it. You all do. Everyone does. This, again, was the bond market days. This was pre-Gordon Gekko, all that nonsense. But he said, you guys, if you understand history, you're going to do better in your fund or in your bank or in your whatever than by understanding balance sheets. And I look back at this, and here's where I'll get sensational. I do think, like Henrik, that we are in a turning point. I think the die is cast now, and not about some potential collapse in futuro, but right now. As we're speaking, it's not something you have to predict or do gloom and doom, gold sensationalism. And the pattern of this collapse, and I'll just say it in a few minutes, is really, and it looks to me like it's debt that compounds, leads to currency debasement. And in that period, you get these, what Paul Kennedy talked about years ago, resentment from wealth inequality, and we have plenty of evidence of that. Populism and violence, we have plenty of evidence of that. You have a cultural breakdown, whether it's BLM to transgender bathrooms to immigrants or whatever. You have that. You have foreign holding of your debt falling. You have centralization, which we've seen in the form of lockdowns. You could argue CBDC, stablecoins, media control, monopoly powers existing today I never would have dreamt of in law school. And then you have flight out of the countries where the centralization and the taxes, et cetera, go. And we work at the Henley Group, Henley Partners. There are 140,000 millionaires relocating in 2025, most of them leaving the UK. So all of these things that were historical examples of an anatomy or a process of collapse are quantifiably happening right in front of our eyes. Whether that collapse happens tomorrow, a week from now, a year from now, where there's a gold value opportunity in the meantime, these are all very important debates. But the net result, I think we all agree on, is that collapse is already in the process. It's frog boiling right now. Even what we see with the stablecoin desperation, the tariff desperation, the political desperation, all of these things which we didn't get a chance to dive into are symptoms of this crackdown. It just reminds me of being back in high school, that in some ways, history is just as, if not more important than math. And yet the math and the history right now couldn't be more corroborative of what the hell we're in right now. It is absolutely objectively crazy. And I love these debates, and I'm glad Henrik had the courage to give it to us the way he sees it. I think it's very admirable, and we'll see. We'll break it down in the next few years, probably.
In my next life, I'll be as eloquent as Matthew. That's what I want to do.
Well, it's easy. It's my language.
English is not my first language, so I'll try to. I hope to be for that.
Yeah, no. All right, guys.
Fantastic put, man.
All right, buddies.
Awesome. Thank you both. Francis is already gone, so we thanked him earlier. But it was definitely good to see you. And maybe, who knows, in a couple of months or in the near future, we might be able to reunite and have those conversations also face to face, which is obviously always more fun.
Would be amazing.
Yeah. Very passionate voices, that's for sure. Yeah.
Exactly. So for the viewers, thanks for listening. Thanks for viewing on YouTube. And if you've been on the podcast platforms, please leave us a review. If you're on YouTube, please give it a like or share. You can follow Matt. You have a Substack that you write through the Fun Greyats Substack in both English and German. Henrik, you are obviously very active on X. You love to also have some debates or argue with some trolls here and there, but most likely just put your thesis out there and also stick your neck out, which also always requires a lot of courage and we'll also respect that goes with it.
And I also have a Substack now, so it's at Henrik Zeberg also, not at Henrik Zeberg, Henrik Zeberg Substack. So
Great.
Beautiful. I'll put all those links down below. Obviously, there's also the Market Sniper Francis Hunt's YouTube channel that he also delivers regular YouTube videos and updates and interviews. And he has a Substack too, and X. He's got it all.
Yeah.
But I'll put everything in the description down below. And until then, we'll keep in touch. And
all right, buddy.
I wish you guys all the best.
Thanks a lot, Alexei.
All right.
Thank you.
Thank you.
We have the largest bubble in the world, which we have right now. Larger than 1929, is larger than 2000. It's double the size of 2007.
The end result is ultimately all roads lead to inflation and currency debasement because it's inflate or die.
I say going into mid of 26, you're going to see a massive Dixie rally, and it's going to crush precious metals. It's going to crush Bitcoin. Is going to be completely annihilated, and then you're going to see the dollar actually, one last time up to the new highs.
I have to challenge you there. First of all, that means somebody has to buy more of it. Somebody has to decide debt instruments are worth way more than they're currently priced at, and has to buy an obscene amount. For every small percentage, they have to actually aggressively buy a market where you have China seeking to exit, you have every BRICS nation seeking to exit.
Gold is the new strategic reserve asset. It's a better store of value than paper money.
But that's not what you can do in a deflationary bust, because that is when the dollar is everything, because you need to pay your debt. So if I get it right,
when you say the dollar is everything, you're saying the debt instrument is everything too. You've got to talk about both. Who's buying the debt? You're going to get caught out trying to buy on a 40% dip that never comes. All sorts of things can occur. Debt-based crash is a fiat-based crash. It's really that simple. The anti-fiat trade is gold. You buy gold, you are actually anti all fiats, and particularly the hegemon fiat. That's the dollar.
And we have in the housing market that tech bubble that is bigger, and we have a crypto bubble that is insane. So take those three and then combine it, and then you have by far the largest bubble now we have ever seen. And